Hello friends, I welcome you to this session on Advanced MS Excel, focusing on Chapter 6, Applications on Excel. I am CA MS Mehta, your mentor for this session. We will be learning practical applications of Excel like depreciation, marginal costing, capital budgeting, EMI, personal financing and related areas. In real life perspective, in our offices, we have to charge depreciation on fixed assets under statutory provisions like Income Tax Act, Companies Act. Excel eases the job of calculating depreciation. Moreover, while planning for personal investments or capital budgeting decisions, Excel certainly helps us in taking decisions. We will see some of these applications in this session. Friends, in this session, we'll understand using Excel in depreciation. We'll gain knowledge of using Excel for marginal costing, cash budgeting. We'll understand use of Excel in EMI calculations, discounting, use of Excel in tax computations, use of Excel for equated monthly installments, for capital budgeting, and use of Excel for personal financial planning. Now, depreciation. Depreciation is defined as a reduction in the value of a product arising from the passage of time due to use or abuse, wear and tear. Depreciation, friends, is not a method of valuation but of cost allocation. Now, this cost allocation can be based on a number of factors, but it is always related to the estimated period of time the product can generate revenues for a company or the economic life. The depreciation expense is the amount of cost allocation within an accounting period. Now, depreciation is a systematic allocation of depreciable amount of an asset over its useful life. Depreciation, friends, is required under Income Tax Act, under Companies Act, as per Accounting Standard 6. Now, depreciation is a requirement under Companies Act 2013 also. The Companies Act 2013 along with Schedule 2 has made some changes to accounting for depreciation. Now, rather than charge of depreciation based on rates, now depreciation has to be charged on the basis of useful life of various assets, where depreciable amount is equal to cost of an asset minus the residual value, and this residual value as per Companies Act 2013 cannot be more than 5%. And useful life is the period over which asset is expected to be available for use. That is, assets have to be depreciated over the useful life. The depreciation method can be straight line or written on value. Under Income Tax Act, as per Section 32, the depreciation is to be charged as per written on values. The prescribed rates the prescribed rates have been specified under Rule 5. Now, if you look at Accounting Standard 6, it defines depreciation is a measure of the wearing out, consumption, or other loss of value of a depreciable asset arising from use, afflection of time, obsolescence through technology and market changes. And depreciation is allocated so as to charge a fair proportion of depreciable amount in each accounting period during expected useful life of asset. Thus, to calculate depreciation, three factors are important. Number one, historical cost or any other amount substituted for historical cost. For example, when asset has been revalued. Number two, expected useful life of depreciable asset, which generally depends on physical wear and tear, obsolescence, legal or other limits on use of asset. And third is the estimated residual value. Now, friends, there are various methods of allocating depreciation over useful life of an asset. Those most commonly employed in industrial and commercial enterprises are straight line method and reducing balance method. Now, the management of a business selects the most appropriate method based on various important factors, for example, type of asset, nature of the use of asset, or circumstances prevailing in the business. A combination of more than one method is also sometimes used. The statute governing the enterprise may also provide the basis for computation of depreciation. For example, Companies Act 2013 or Income Tax Act prescribed the methods which could be used for charging the depreciation. Now, there are some functions in Excel which can be used to calculate depreciation. We have got SLN, which is to calculate depreciation as per straight line method. Then we have declining balance method, which can be used for return on values over useful life of an asset. However, depending on the management perception, some more methods like double declining balance or variable declining balance the method are used, and in some cases, sum of the year digit method are also used. Now, under Companies Act 2013, asset should be depreciated over the remaining useful life of an asset. The useful life has been described as per Schedule 2. Now, most of the companies and listed companies rather use straight line method. Now, to calculate depreciation under straight line method in Excel, we have a function SLN. The SLN has got, if we look at the syntax of SLN, it has got three factors: cost, salvage, and life. Well, let's understand how we can use this function. We have this Excel sheet where the cost of asset is 2,40,000 and the residual value or the salvage is 1,20,000 and the useful life is 8 years. Now we want to calculate depreciation as per straight line method. Now if we consider this, then is equal to SLN. Now first it says cost. We select the cost and we absolute it. Then the salvage or the residual value is 1,20,000. We again absolute it, and then the useful life, which in this case is D1, and we again absolute it. So what we have described is we want to calculate depreciation as per straight line method, where the cost is 2,24 lakhs, the salvage value is 1,20,000, and useful life is 8 years, and the depreciation is 2,85,000. Now we simply drag this formula across 8 years, and what we have is we have calculated depreciation as per straight line method for asset over 8 years, and the asset has been depreciated to 20,80,000, which is the depreciable amount, and depreciable amount, as we already discussed, is cost minus the salvage value. So friends, we have seen how we can use SLN function in Excel again to calculate depreciation as per straight line method. Now another method could be written down value method, and under Companies Act 2013 there is an option of charging depreciation as per straight line method or written down value method, and written down value method is also adopted by many companies to charge depreciation, where depreciable amount has to be spread over useful life of an asset on accelerated methods. Now we could use the function db here. Now in the case of db, depreciation is equal to cost minus total depreciation from prior periods multiplied by the rate. Now to calculate depreciation under return on value method, we apply depreciation at a fixed depreciation rate to the written down value of the asset. Now rate is equal to 1 minus salvage value of the residual divided by cost to the power of 1 upon life. So that is the formula which is used to calculate rate of depreciation, where life, salvage and cost have been given. But in Excel we got a very good function by the name of DB, which calculates as per the written down value, okay, over the useful life of an asset, where the four parts of the syntax are we need cost, we need salvage, we need life of an asset or the useful life of an asset, and the period. Period is to which year this depreciation relates. And if it is like for the first year, there could be part of the year also, like asset could be only for 2 months or 3 months. So in that case we have the option of a month also. If we specify the month, then prorated depreciation only related to that period or those months is calculated by this function. Let's see how we can do it with a practical example. Now again we come to the same sheet, but this time we want to charge depreciation as per written down value method. So we set up the formula is equal to dB. Now the syntax is number one is the cost. In this case it is V1 absolute. Then we have salvage, which is 1,20,000, and we again absolute it. And then we have life, which in this case is 8 years, and we again absolute it. So the useful life, and then it says period. Now this is period 1 or the first year. We want to calculate depreciation as per written down value method for the first year. So after setting up this formula, a month is optional. In case first year your asset is only used for a part of the period, we can also include month so that prorated depreciation is calculated. In this case, our depreciation is calculated, and as we copy the formula, what we have is depreciation which has been calculated by the written down value method. This depreciation method is valid for Companies Act, under Companies Act, where asset has to be depreciated over the depreciable amount over a useful life. So friends, we have learned how we can use the DB function to calculate depreciation as per written down value method over useful life of an asset. Now, the management may desire to calculate depreciation using accelerated depreciation methods like variable or double declining methods and some of the year methods. Let's understand these methods and learn to apply them. Variable declining method, when we use variable declining method or double declining method, the depreciation rate stays the same, but the depreciation expense gets smaller each period, and the depreciable base also gets smaller each period, right? So here depreciation is charged at multiple of the normal rate. Okay, now under this method depreciation is charged at multiple rates. That is, we first calculate the depreciation as if using the straight line method. Then they figure out the total percentage of asset that is depreciated in the first year and multiply it. In each subsequent year, that same percentage is multiplied by the remaining balance to be depreciated. Now here what would happen is at some point of time, the value would be lower than the straight line charge, at which point the double declining method or the variable declining method will be scrapped, and straight line would be used for the remaining life of an asset, which we'll see when we see a practical example of this. Now here we can use the function VDB, where the syntax has we need cost, we need salvage, we need the total useful life, the starting period for which depreciation is to be charged, the end period for which depreciation is to be charged. Now factor is the rate at which balance declines. So if the factor is 2, means it is double declining. If it is 3, means it is triple declining. So this is how much time, how much multiples of the rate we want to charge. Let's try to use this in a function in an Excel sheet to understand more of it. But first, we'd also like to discuss one more method, which is sum of the year method. The sum of the year method is again an accelerated depreciation method, which uses the formula depreciation is equal to cost minus salvage into life period plus 1 into 2 divided by life into life plus 1. Now, this is an accelerated method where it is based on the assumption that asset is more useful in the initial years. Okay. Now, to calculate the depreciation charging using this method, we take the expected life of an asset and count back to 1 and all the figures together. For example, if we take this case to be 8 years, then we'll add 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1, where the sum of the years becomes 36. Or it is, we can also use the formula n factorial, which is n into n plus 1 divided by 2. Now, this sum of the year method assumes that first year 8 upon 36 of the asset would be depreciated. Okay, that is, depreciation rate in the first year would be 22.2%, which is 8 upon 36. And in the second year, it would be 7 upon 36 or 19.44%. And maybe 6 upon 36, that is 16.66% in the third year. Okay, so here depreciation in the initial years is accelerated, right? So here Excel has got a very good function by the name of SYD, which is sum of the year digits, which can calculate this accelerated depreciation by the method of sum of the year. And the syntax required is cost, salvage, life, and period to which this relates. Now, we'll be in a practical example seeing how we can use variable declining method and sum of the year method with a practical example. Now we go to the same sheet we had gone earlier, and we'll this time calculate with the help of VDB. We'll set up the formula. First again is cost, absolute, then salvage rate, absolute, and then it says life, which is in this case is the useful life, again absolute. Now it says start period. Now for the first year, start period would be 0. So we could use the formula A5 minus 1, which will give us the starting time, and the ending time would be A1, sorry, A5. Now it wants a factor, how many times it should be depreciated. If we want double declining, we could use 2. Okay, so let's use 2. We want it to be double declining. Then it is a number switch. It says, if it is true, it says do not switch to the straight line depreciation, and if it is false, it says switch to straight line depreciation. As we discussed earlier, there would be some point where the value will be lower than the straight line charge. At this point, the variable declining method has to be scrapped and it has to be shifted to SLM or the straight line method, right? So in this case, we wanted to switch to straight line method, so we can use 0 or we can use false. So in the first case, it is 6, and if we just copy the formula, okay, the whole the amount of 22,80,000 is depreciated. But if you look at 6 year, 7 year, and 8 year, this has become a straight line. That is, we have the same depreciation which is charged across all years. Similarly, we'll also look at how SYD works. We'll go to sum of the year method. Again, the syntax is same. We have the cost, absolute, comma, the salvage value, again absolute, and useful life, in this case is 8 years, again absolute, and then the period, it is first year, so we have A5. Now this is calculated, and if we drag this formula, so again what we find is initial years depreciation is high and then it reduces. So we have calculated depreciation as per sum of the year methods. Now, these methods, variable declining method and sum of the year methods, are used based on management perception, how they want to depreciate their assets. Now, friends, if we consider Income Tax Act, then under Income Tax Act, depreciation has to be charged at specified rates. Now, let's try to calculate the depreciation here. Now let's assume that for this asset the rate is 15%. So under the Income Tax Act, so in Income Tax Act, to calculate depreciation, what we do is we multiply the cost, which in this case will be multiplying with the rate of depreciation, because this rate of depreciation will remain constant, we'll better absolute it, and what we get is depreciation for the first year. Now the written down value at the end of first year would be cost minus the depreciation. Now in the next year, the depreciation has to be charged on the written down value at the end of first year. So again what we'll be doing is we'll multiply the value at the end of first year with the rate, and again since we want to copy this formula, what we'll do is we'll absolute it. Now the written down value would be the written down value as at the end of first year minus the depreciation charged for the second year. Now friends, we can easily copy this formula, okay, and we have learned how to calculate depreciation as per Income Tax Act. So friends, we have seen how we can use Excel to calculate depreciation as per straight line method, declining balance method, variable declining methods, sum of the year methods, and again written down value at specified rates as specified in the Income Tax Act. Now if we chart out this whole thing, then this is the way different depreciation methods are reflected on a chart. Straight line method, as you can see, it gives us a straight line, whereas a declining balance method and variable declining methods give us accelerated depreciation in the initial years, and they taper out and reduce over the later years of the asset. Next friends, we'll consider marginal costing. Now marginal costing is a system of calculating marginal cost for the purpose of financial and business decisions. Various concepts and tools are used for calculating marginal costs for the purpose of business decision making. Now marginal costing may be defined as a technique of presenting cost data wherein variable costs and fixed costs are shown separately for managerial decision making. Now, marginal costing is not a method of costing like process costing or job costing. Rather, it is simply a method or technique of analysis of cost information for the guidance of management, which tries to find out an effect on profit due to changes in the volume of output. Now, It provides management with the information regarding the behavior of costs and incidence of such costs on the profitability of an undertaking. It could be specially be useful in managerial decisions relating to determination of optimum selling price, to check the effect of reducing the current price on profit, to choose the good product mix, calculation of margin of safety, decision regarding whether to sell goods at different prices to different customers. Now, marginal cost distinguishes between fixed cost and variable cost. Marginal cost is the cost of producing one more unit of a product. It is computed in situations where break-even point has been reached. The fixed costs have already been absorbed for already produced items, and only the direct variable costs have to be accounted for. Now, the whole idea of marginal costing revolves around one simple equation, which is fixed cost plus profit is equal to sales minus the variable cost. One key idea which is used in marginal costing is that of break-even point or BEP. Now, BEP is a point of no profit or no loss. It may be expressed in terms of sales value or sales unit. And if we consider break-even point as per value, it is fixed cost divided by PV ratio. The PV ratio means profit to volume ratio. Now, to calculate PV ratio, we use the formula sales minus variable cost divided by sales into 100. This is a formula which is used to calculate PV ratio. And if we want to calculate BEP in terms of units, it is fixed cost contribution per unit. Now, contribution per unit is selling price per unit minus variable cost per unit. So, marginal costing is formally defined as the accounting system in which variable costs are charged to cost units and the fixed cost of the period are written down in full against the aggregate contribution. Its special value, is in decision making. Now, to understand this, let's prepare a chart showing break-even point when selling price is 600 and variable cost is 250 and fixed cost is 4200. In this case, contribution per unit would be selling price minus the variable cost, and the units sold, let's say we have only one unit sold, and the total contribution is equal to contribution per unit multiplied by the number of units, and the profit is negative, that is we have a loss here. Now, to calculate the BEP, let's try it across different units. 600 remains same, 250 again remains same, contribution again remains same, but total contribution changes. Fixed cost is again the same, and the profit, if we look at, there is this point of 12 units where there is no profit, no loss. So in this case, the break-even point is 12 units. Now let's consider another case where we have to make pricing decisions. Excel can also be used for taking decisions on product pricing. When large size data is to be handled, Excel can be really useful in such cases. Let's imagine a company manufacturing cricket bats, which can be sold for a price ranging from 300 to 10 to 1000, let's say. And the variable cost, let's assume it at 250, and the fixed cost is 10 lakhs. Now we want to calculate how many bats should be produced to achieve break-even point. Now we could have an Excel sheet like this. Now in this case, selling rate could be 1000 to 400, okay, or we could also include 300, okay, and the fixed cost is again 10 lakhs. Now the contribution per unit we already learnt is selling price minus the variable cost per unit, and we drag it, we get contribution across different price bands. Now break even point is the fixed cost divided by contribution per unit, okay. And so again, to break even, if the organization keeps the price at 1000, it has to produce 1333 bats. Whereas it keeps the price at 300, it would have to produce 20,000 bats. So with the use of this marginal costing and use of Excel, we can take a decision on the pricing. What is the price which should be taken? So friends, we have also seen that the marginal costing can be facilitated using Excel. In cash budgeting also, Excel can help us. Now, budget stands for planning for the future. Cash budget is prepared for planning for future as far as movement of cash is concerned. Now, a cash budget is management plan for most important factor of a company's viability, that is its cash position. A cash budgeting involves an estimation of the cash inflows and outflows for a business or an individual for a specific period of time. The objective of cash budget is to assess whether the entity has sufficient cash to fulfill regular operations and or whether too much cash is being left in unproductive capacities. So cash budget is used to assess whether uh, a smooth flow of cash is being maintained in the business as well as to ensure liquidity during the budget period. Now, many financial and business decisions are taken on the basis of cash budget. For example, how much credit to be given to the customer, how much funding to be taken from outside sources. Now, cash budget is a detailed plan showing how cash resources will be acquired and used over some specific time period. Now, cash budget, broadly, if we look at, has four major sections: the receipt section, or the inflow section, disbursement section, or the outflow section, the cash excess or deficiency section, and the financing section. The cash receipt section consists of listing of all cash inflows, okay, and disbursement section consists of all cash outflows or cash payments, and cash excess is computed as cash balance add receipts less disbursements, which gives us excess cash. And if there is excess cash during any budgeted period, funds borrowed in previous year can be repaid or excess funds can be invested. The financing section deals with borrowings and repayments projected to take place during the budgeted period. The cash budget preparation and presentation can be again be facilitated by using Excel. We'll see just an example of how cash budget has been prepared using Excel. As we can see in this sheet, uh, as we can see in this sheet, for different months the inflows have been planned, and based on inflows from cash sales, from debtors and all, what we have is total inflow, which is 6,20,000, and we also map out the outflows and opening cash. We have the surplus deficit can easily be calculated with Excel using a simple formula, and the closing balance also we can use a very simple formula. So if we have these figures, we can very easily using Excel again prepare a cash budget. Now, Excel can also be used to find out discounting factors and discounting of the cash flows. See, if I give you an option, get rupees 100 from me today, or I could give you rupees 100 a year from now. Which is option you'll prefer? Obviously, the first one. You'd want rupees 100 today, because rupees 100 today is not is equal to rupees 100 a year from now. Now, time value functions, time value of money calculations are based on the principle that funds placed in a secure investment earn interest over time. A discount factor can be thought of a conversion factor for time value of money calculations. The compounding principle states that if we have an amount P to invest now, the present value, the future value will increase to F is equal to P multiplied by 1 plus rate of interest to the power n, where n is the years and r is the rate. Now, the discounting principle says that if we want to have F in n years, we need to invest P right now. So, the discounting is basically just the inverse of compounding. That is, if we invest 10,000 now for 5 years at 10% interest per annum, we will have a total investment of 16,105 rupees at the end of 5 years. On the other hand, if we want to have 16,105 rupees in 5 years time, how much money we need to invest now at 10% interest per annum? So this is a reverse of the situation which we described above. So if P is the present value of money, then the present value of rupees 16,105 at 10% interest after 5 years is 10,000 today. Now, to convert future value of the equivalent present value, we simply multiply the future value by the discounting factor. Now, in the past, friends, it was common to refer to discounting factor table to look up the number needed to perform a time value of money conversions. But today we've got spreadsheets to aid in performing these functions. Now, using Excel, we can find the discounting factor, and we could use a simple formula of 1 divided by 1 plus r to the power n. Let's try it with a practical example, and then discounting factor multiplied by future cash flow gives us present cash flows. Though we also have some Excel functions, present value, future value, IRR, which deal with the discounting. But we'll see all these functions later on in the session. Now, in this sheet, rate of interest is 11%, and if we want to calculate discounting factor across different years, then let's drag it across different years. Let's say I want it over next 8 years. Okay. Now, to calculate discounting factor, we have this formula 1 divided by 1 upon r to the power n. So we can use this formula again in Excel. So this is equal to 1 divided by bracket starts 1 plus rate. Rate in this case is 11%, absolute, then to the power n, where n is the years. Okay, so we have this formula which gives us the result of 0.9009. If I drag this across various years, I get discounting factor over the next 8 years. Now, if we change this formula from 11 to 10, then we can very easily get a discounting factor for 10%. So friends, we have learned how we can use Excel again to find the discounting factor. Now, Excel can be conveniently used for preparation of tax computations. Let's prepare a tax computation sheet using some of the Excel features. See, first of all, we need to create a file and format it as per the computation. Then the next step perhaps would be to put some kind of input validations. For example, we could have input validation for date of birth. We could have input validation for PAN, for value, for some kind of lists which are needed. We'll see a practical example of how we can do it. Then the third step would be to have automatic text calculation using Excel. Okay, and the method of text calculation shall change according to status of SSC, date of birth. For example, if the individual is less than 60 years, the rate would be different. The tax would be different. But if it is more than 60, then tax would be different. So we can even set different calculations for it. Okay. And the third, we could use the function VLOOKUP for calculating tax. And the fourth step would be sheet and cell protection. We wouldn't want any user to change the cell format or the formulas which we have put in. So once the basic format is ready, validations have been put in, we can move towards locking the sheet or cells for editing. Now this will prevent the user from changing the sheet formatting, titles, and thus disturbing a computation sheet. Now with a practical example, we'll see how we can do all this. Now we have set up a basic sheet where we have a format of text computation. We've got SSC, PAN number, date of birth, previous year, assessment years, the status, okay, and the various things are there. Now the first thing we'd like to put in some kind of validations. We don't want anybody to mess with the date of birth or to put any wrong data within the date of birth. So in data we have the option of validations. So we could go to cell validation, data validation, and what we'd want is here it should be some kind of a date. Now we can also set up between which dates we want the date to be. So the starting date again could be first of January, maybe 1900, which could be the starting date, and the last date again could be maybe the current date or the current of date of last year. Now what this will ensure is that the dates are a valid dates which are between these two dates. Now once we put up the validation, if we try to enter some other number within it, it will block us from doing it. So the chances of wrong entry are decreased. Now let's say we could also put up validation from certain lists. Here we want, if you have to put up the status could either be association of person or artificial juridical person or body of individual, so on and so forth. Now we want in this cell only the data values should come from this list. So we could also put up a list validation. We'll again go to cell validation, and this time what we want is a list. Okay, now this list would be from this to this, that is from association of person to trust. Okay, so once we put up this cell validation, we'll see this kind of a drop down menu come, and we can select out of this. So if it is a artificial juridical person or HUF, let's say this is an HUF, so we have to simply select from this list. Okay, so friends, we have learned how we could put input cell validation. Now next step would be to calculate taxes. In this case, let's forget for a minute section 87, and that rebate of 2000. We don't want that rebate of 2000, and we want to calculate the taxes. Now, if the taxable income is this one, what we want is that tax should come here. Now, we can use this very conveniently using a VLOOKUP formula. Okay, taking the existing rates, this is income, and the tax. Now we say if the income is 0 and the next slab is 2,50,000 and the next slab is 5 lakhs and the next slab is 10 lakhs. Now if the income is 0 to 2,50,000, the tax would be this income multiplied by 0%. And if it is above 2 lakhs, 2,50,000, then tax rate would be total income minus 2,50,000 multiplied by 10%, and let's round it off so that we get a proper number. Okay, and in the next slab, if the income is above 5 lakh, then the tax would be this minus 5 lakh in this case multiplied by 20%. Okay, and plus 25,000, which is the income, which is 10% up to 2,50,000. Okay, after considering the basic exemption of 2,50,000. Now the income would be 52,262 on this income. Now if we go to the next slab, in this case this 5 lakh will become 10 lakhs, this will become 30%, and then we have 1,25,000, which is the tax up to rupees 10 lakh. Now to calculate income tax, we use the VLOOKUP formula. VLOOKUP formula, the syntax is what to find, where to find it within this array, and result has to come from second column, and what we need is approximate match. So we could use the value 1 or we could write true. So what we see is it has automatically calculated the rate, and education cess again is tax multiplied by 3%. So friends, again using VLOOKUP, we have learned how we can calculate tax on a specified income. Now the next step would be locking this. See, by default, all the cells in Excel sheet are locked. So we must first unlock the cells which we wish to keep open for users for data input. We First select the whole sheet, and we go to format cells, and if we go to protection, we find that all the cells are locked. So we'll first unlock all the cells so that all our cells are unlocked now. Then to find wherever the formulas are there, because we don't want anybody to mess with the formulas, we'll go to find and select, go to special, and go to wherever there are formulas. So all those areas where there are some kind of formulas are highlighted. Okay. Now what we'll do is, again we go to format cells, and in format we'll lock these cells as well as make them hidden. That says hiding formulas has no effect unless you protect the worksheet. Okay, so if we hide the cell, nobody can see our formulas also. Okay, so what I've done is I've unlocked them now, but this won't take place unless I have protected it. So for protection, I go to review, then I go to protect sheet, and I select the option, select unlocked cells and unlock cells. I put in some kind of a password. I reconfirm the password, and my cells are locked. So if I come to this, nobody can see all those formulas which have been put in here. And if somebody wants to change it also, it says this sheet is protected. So friends, we have learnt how we can create a file, how we can put input validations, how we can calculate text, and again sheet and cell protection. Friends, EMI calculation can also be facilitated using Excel. We take a loan from a bank, and bank demands loan repayment in form of equated monthly installments, which is the common name is EMI. Now this is the amount we'll have to pay every single month when clearing our loan. Now, it could be a home loan, a personal loan, a vehicle loan, a consumer durable loan, or an education loan. Now, EMI combines principals as well as interest. It's a fixed amount of repayment made every month towards loan, and is an unequal combination of principal and interest rate. In the earlier years of repayment, it is mainly the interest payments that are being made, while the principal amount is much less. Towards the end of the repayment tenure, it is more of principal that is being repaid and not interest. Now, after sanction of a loan, bank gives us a table which specifies EMI along with split of principal and interest portions. This is variously referred to as amortization schedule or EMI table. Now, Excel has got three functions: PMT, IPMT, and PPMT, which could ease our job of preparing a amort schedule or a amortization schedule. Now, PMT, the syntax is, we need rate, we need total number of payments, PV is the present value, FV is the future value, type is a number which could be 0 or 1, which will depend on whether you are repaying at the beginning of the period or end of the period. So rate, we need to specify interest rate, NPR is the number of payments, and PV is the present value, FV is the future value, and type is 0 or 1, which depends on when the payments are due. That is, you will be paying the EMI at the beginning of the month or the period or end of the period. Similarly, we have a function PPMT, IPMT, which can be used to segregate the principal and interest portion out of an EMI. Now here again, rate is the interest rate, PR is the period, that is whether it's first period or second period or third period. NPR is the total number of payments, so the total number of periods over which the repayment has to be made. PV is the present value, FV of course optional is the future value, and type again is when the payment is being made at the beginning of the period or end of the period. Now, to take an example, we'll prepare an amount statement for a loan of rupees 8 lakh at a rate of interest of 12.5% per annum for a period of 24 months. Now, we wish to calculate EMI. Okay, now we'll put up a function here for EMI, which we have seen is PMT. PMT is a function which could be used to calculate EMI. Now, friends, first a food for thought. If we consider any kind of discounting or other financial functions, all these functions involve cash inflow as well as outflow. Okay, therefore, if in a present value amount is invested, in the future value amount would be received. Okay, that is, the direction of cash flow would be different. Therefore, when we present PV as positive, we take FV as negative and vice versa. That is, wherever present value is negative, future value would be positive. So in this case also, because we have taken a loan, if we take it as plus, the payments would be negative or minus. Okay, so in this case, we first have the rate. Now, but important thing about rate is rate should correspond to the period. Okay, so here we are making monthly installment, whereas rate is per annum. Now, to make it appropriate, what we'll do is we'll divide it with 12, so that what we have now is a monthly rate. Then what we have is number of periods. Now, periods here are in 2 years multiplied by 12 payments. So that is, we have to make 24 payments. How many payments have to be made? And present value is 8 lakhs, whereas future value has to be 0 because full loan has to be repaid. And again, type is, again we take the default type, which is at the end of the month. Now, the repayment required would be 37,845 rupees, and you can see this is a negative because this is the payment we have to make. Now, to calculate the principal portion out of it, we use the function PPMT, and here again what we have is rate. In this case we absolute it because we'll need to copy this formula, and period is the first period, and total number of periods are again absolute multiplied by the number of installments, again absoluted, comma, the present value is 8 lakhs, again absoluted. Okay, so what we have is now the principal value, and similarly we can also copy this formula to get IPMT. We can change it to interest. What we have is interest PMT. B5 will remain the same, only the thing which needs to be changed is this period, okay, which would be, in this case, would be again 18. Okay, now this we can drag across the 24 periods, and what we get is the interest and the principal portion out of the EMI. Now, if I want to calculate the balance, I could take the formula as total loan, the principal which has been repaid, and in the next period it would be the opening balance and the repayment. And if I copy this formula, we see my full loan has been repaid because the balance is 0. So friends, we have seen how we could use Excel again to make an amortization statement, and again how we can find EMI and the principal and interest portions of those EMIs. Now, Excel also facilitates capital budgeting. The capital budgeting is the process in which a business determines whether projects such as building a new plant, investing in a long-term venture are worth pursuing. Oftentimes, a prospective project's lifetime cash inflows and outflows are assessed in order to determine whether the returns generated meet sufficient target benchmark. So, ideally, a business should pursue all projects and opportunities that enhance shareholder value. Some popular methods which are used for capital budgeting are net present value, internal rate of return, and discounting cash flows. So obviously, Excel can be of great use in capital budgeting. Let's understand some of these scenarios. Scenario 1, our client is planning to sell his machine and purchasing company offers him two options. Option 1 is to take lump sum payment of rupees 7 lakh, and option 2 is payment of rupees 2 lakhs as down payment and payment of rupees 1 lakh at the end of year 1 and 2, further payments of rupees 75,000 at the end of year 3 to 8. Now he comes to us for consulting on which option to accept, considering the rate of return at 80%. Now in this case, to compare these two options, we need to find the present value of option 2, which we can easily do using the function NPV. NPV gives us the net present value. It is the value of all future cash flows less future cash inflows less future cash outflows as on today. Now here the syntax required is one is rate, another is the values. Now we set up an Excel sheet like this, where in the first option 7 lakh we receive upfront. In the second case 2 lakh is a down payment, and we got all these values at the end of year 1 to 8. And the assumed rate of interest is 8%. So we can use the NPV function to calculate it. What it wants is number 1, the rate, and then the values. The values in this case would be all these values. Okay. Now, because in this case there is a down payment also, we'll add that down payment again to this formula, which in this case is 2 lakhs. So the net present value of these cash flows is 6,75,000. Now, even though friends, it could look like that we are getting more money in option 2, but if we consider the time value of money, then it is much less. Okay, it is only 6,75,000, even though as compared to 7 lakh, 8,50,000 would seem high. But if you consider the interest factor, the time value of money, in fact, in the second option, we are getting a much lower amount, which is only 6,75,000. So obviously, option 1 is better for the client as compared to option 2. Let's consider another scenario. A client is planning to sell his machine, and the purchasing company offers him two options. Option 1 is to take lump sum payment of rupees 7 lakh as on 1st of April 2016, and the option 2 is you take 2 lakh on 1st of April 2016 as down payment, then two payments of rupees 1 lakh on 1st of May 2017 and 1st of April 2018, and further 6 payments of 75,000 on various odd dates. Now he comes to us for consulting on which option to accept, considering the rate of return at 8%. Now see, this time the cash flows are not at the same frequency period and are not even also. Now to compare these two options, we need to find the present value of option 2, which we can do using the function xNPV, which has got three in syntax. It has got three things which are required. One is rate, other are values, and third are dates. Now with the example, we'll see how we can do it. Now we set up a sheet like this, and in this what we want is to calculate the net present value of all these cash flows. Okay, the first is rate. Okay, and then the second syntax wants again the dates. The values, and the third thing required is the dates. Now because in this case we got date for the down payment also, so we are taking all these dates, and if we calculate this, the result we get is 6,70,000. That is, it's even lesser than the previous option. So in this case also option 2 would be better as compared to option 1. So we have calculated net present value of a series of irregular cash flows using the function XNPV. Consider one more scenario. Client is getting an investment opportunity in two projects. Okay, assuming there is no shortage of funds with the client. The cash inflows of two projects are as follows. In project 1, he has to right now invest in year 1 40 lakh rupees. In year 2, he will have inflow of 13 lakh rupees. In year 3, an inflow of 19 lakh rupees, and year 4, inflow of 26 lakh rupees. Whereas in the second project, he invests rupees 80 lakhs, and in the first year there is an inflow of 36 lakh rupees, and then year 3 again there is 36 lakhs and 36 lakhs. So the inflows are even in this case. The company wants to invest only in one out of the two projects, and he comes to us for consulting on which project to choose. Now to compare these two projects, we need to find the internal rate of return of both the projects to assess which is most profitable. Now IRR, or internal rate of return, is a discount rate used in capital budgeting that makes the net present value of all cash flows from a particular project equal to 0. So generally speaking, higher a project's internal rate of return, more desirable it is to undertake the project. As such, IRR can be used to rank several prospective projects a firm is considering. Assuming all other factors are equal, the project with the highest internal rate of return would probably be considered the best and undertaken first. Now here we could use the function IRR, where we have to give it the values and a guess is there. The guess is a number that we can guess is close to result. Okay, and by default it takes it as 10% or 0.1. Now in case there are irregular functions, we have one more nifty function which is XIRR. Okay, because in this case cash flows are regular, but cash flows could be irregular also. So if they're irregular, we can use the function XIRR. Now we set up the sheet as shown here, and then we calculate the IRR. Now what we need is all these values, and guess we can give it as 0.1, and we get a internal rate of return of 19%. Whereas if you consider the second project, okay, then in that case the internal rate of return is 17%. So even though second project looks good, but if you look at the IRR, first project is definitely better as compared to the second project. So we can use this function IRR again to find the internal rate of return of a project. So friends, in capital budgeting we have seen three functions: NPV, XNPV, IRR, XIRR, which could make our decision making process very easy as far as capital expenditure of a company is concerned. Now, planning is considered to be primary requirement for moving towards any goal. And financial planning is the process of meeting the financial goals through proper management of finances. And this is even required in case of any personal goals. Okay. Now, the goals could be buying a home, saving for your child's education, or planning for retirement. Okay, so personal financial planning in case of most of the individuals shall include planning for retirement, decision about home loans, budgeting for major expenditures like marriage, education. Okay, so Excel could help us in making these decisions also. Let's consider a scenario where client is planning to invest some money for his son's college admission fee, which he estimates would be 20 lakh rupees after 13 years. Now he has an opportunity to invest at 11% interest rate. He wants to know how much he should invest. Now here, a very nifty function of Excel, PV, or the present value, could help him out. The present value is the current worth of a future sum of money or stream of cash flows given a specified rate of return. Okay. Now, in this case, the syntax is rate is the interest rate per period. NPR is the total number of payments or periods in an annuity. PMT is the payment made each period. FV is the future value, and type is again when the payments are due. So let's see this with a simple example how we can use this for this kind of a scenario. We'll be using the function PV to calculate it, where the future value required is 20 lakhs, years are 13, and the annual interest rate is 11%. We use the function PV, and if you look at the syntax, first what we need is a rate, okay, and then the number of periods, okay, and then the payments which is to be made. Okay, so because we are making a lump sum payment, we don't need to make any other payments which are there, and so we'll have 0, and the future value required is 20 lakhs. Now this gives us the target of 5,15,028 rupees. So that is, if he invests 5,15,028 rupees at 11%, after 13 years he'll be getting 20 lakh rupees. So PV function can be used to find present value of a future of any future value. Consider another scenario where client is planning to invest rupees 7 lakh, his target maturity is rupees 20 lakh, and he has an opportunity to invest at 10% interest rate. Now he wants to know for how long he should invest it. In this case, we have a function NPR which can help us, and the syntax required is again a rate, the payments made, present value, future value, and again the type. So we'll see how we can use this. Now here we have set up a sheet where the present value is 7 lakh and the future value is 20 lakh and the rate is 10%. We want to know how much period it will take to reach the target amount, and again the function is NPR, and the rate is, of course, and the payment is in this case 0 because we are not making any periodic payments, and the present value is 7 lakh. The future value is 20 lakhs. Okay, so here, because present value, one of these has to be minus, because as we discussed earlier, the direction of money is different. So if we take it as minus, what we get is we'll be needing 11 years again to get the desired future value. Consider one more scenario where the client is planning to invest 7 lakh in some investments with a maturity of 20 lakhs after 10 years. He wants to know what is his rate of return. So here we could use the function rate to calculate it. Let's see it with a practical example. In this case, we have set up a sheet where the present value again is 7 lakh, and we want to calculate the rate. And again, in this case, we use the rate function. Rate. Again, what we need is period, which in this case is uh, 10 years, and the periodic payments again are 0, and the present value is in this case again minus, because for the reasons we've already discussed, and the future value is 20 lakhs. Okay, and what we get is the rate. So he has to invest the money at 11.07% rate. To his rate would be 11.07%. That is his return. So friends, we have seen how we can use the function PV, NPR and rate again for taking personal financing decisions. Now, to summarize, Excel is a great tool for excelling in a lot of functions which we have to perform. In this chapter, we have learned to use Excel in depreciation using formulas, as well as various kind of depreciation using Excel functions meant for depreciation. We have also seen the use of Excel in performing marginal costing analysis and preparing cash budgets. In taking various financial decisions, considering the time value of money is important, we have learned how Excel could be used to help in present value and future value analysis, so that we can take effective decisions. Uh, in calculating EMI or to prepare amortization schedule, Excel is a boon, and we have seen how we can use the functions like PMT, PPMT, IPMT, and of course income tax computations are eased using VLOOKUP and some other functions in Excel. In case of capital budgeting and personal financial planning also, Excel helps us a lot with the functions like NPV, IRR, with functions like PV, rate and NPR. So Excel is an indispensable tool as far as practicing chartered accountants, and even for any financial use, Excel is a great tool to use. Thank you friends, thank you very much. Till we meet again.